let's just start. First of all, thank you for attending. We appreciate your attendance and your interest in these videos we're doing, these webinars. We've gotten some really positive feedback from them. I guess we've probably been doing it for maybe a year and a half now. So we appreciate your feedback and thank you for that. And speaking of feedback, just want to make an announcement for our clients. We're going to be doing a client survey, and we'd appreciate your participation in it. Hopefully, it won't take too much of your time, maybe 5 to 10 minutes. But starting next week, you'll be receiving webinars not webinars, but emails inviting you to participate in the survey. So keep an eye out for that. We really appreciate your participation in that. We've done these before in the past, and we really take them to heart. But we just want it gives us an opportunity to improve what we're doing for you, take a look at how we're delivering our services and how we're communicating to our clients. And we can't improve without your input on that. So thank you in advance. And if you've got any questions or concerns, let us know. Thank you. So today's webinar, I guess we're calling this the spring market recap or something of that nature, but I think we should probably come up with a better name. But we're kind of tapped out on creativity, I think, for a minute here. So I guess before we just get started, I just want to set the stage very, very briefly. And that looks like the markets have stabilized this year, year to date so far, coming off kind of a volatile 2022, and we'll get into that in more depth going forward. But in recent months, some things have kind of come up, particularly in the current news, like the bank crisis. There's debt ceiling fight boiling, starting to boil here. And there's some other concerns going on in the news that we're also going to address. So, but we're going to start this with just not a brief, but with a Q1 kind of market recap. But here's today's agenda. We're going to start with a recap for the first quarter, the first 3 months of the year. We're going to go into the recent events that I've kind of hinted at there a minute ago. And then we'll go into kind of the ongoing discussion that we've been having for, a year and a half. That is inflation, the economy, interest rates. Are they continue to rise? Will the Fed pivot? We'll kind of address some of those ideas and thoughts a little later. And then we're going to spend some time kind of looking ahead, mainly with, focusing primarily on the markets, but also the economy as well. And of course, probably a more important agenda item is, Mark, make sure you hit the record button. That's so for later viewers, I should say. So here, Mark, you want to address this part of the discussion here about recapping what's been going on from January through March?
Sure. Thanks, Dan, and thanks everyone for attending. As always, we really appreciate it. Also, one thing that Dan didn't mention that I think it's important to mention: if you do have questions, please, I think you can use the chat function on this. So we'll be monitoring those, throughout this webinar, and we can hit those either as we're going through it or at the end. So we appreciate any comments.
Thanks, Mark. Yeah, there's actually two ways. There's the chat function, and there's also a Q&A, and we'll try to monitor those as we go through and answer questions at the end of the webinar.
Okay. So just to recap, this is kind of a Q1 recap, but just going back to the fourth quarter, as Dan mentioned, we, the market's been, obviously down, both stock and bond markets. And I've mentioned this in the last webinar, and I'll mention it again. Last year was one of the hardest years I've ever had, or as investors we've ever had, especially if you are moderate on the risk level or scale, or even conservative, because stocks and bonds were both down double digits, which is, as far as it's never happened in my career. I think it goes back way back. So the good news is the S&P 500 hit its low in October of last year. I think it was down 25% from the top in January of last year. And since then, we've had a pretty nice recovery. And as you can see in the, let me get my little pointer here. In the first quarter, U.S. stocks, this is the overall U.S. stock market. This includes every stock in the U.S. indexes was at 7%. International stocks had a big rally, 8%. Emerging markets are still trailing a little bit, up 4%. Real estate's come back a little bit. And then also great news, the bond market is starting to come back, which is a nice respite from last year. And in later in the webinar, we'll kind of talk about what we think might happen or what could happen, throughout the remainder of this year. So this goes back looking the last 12 months through March 31st. So this doesn't cover the first quarter of 2022, but it does cover the last 12 months. But as you can see, the U.S. stock market's still down about 9%. International stocks are down. International developed, and again, just to remind you, international developed is going to be mostly Europe. It's going to be Japan, more developed economies. And then emerging markets are still down 11%. Real estate's down 20%. And bonds, as you can see, are still down. So we are still digging ourselves out of the hole, and there's still a long way to go. But these markets always do end. It's just a matter of when are they going to end. So let's go to the next slide. Now, just to kind of drill down on U.S. stocks, because most countries have a bias to their own stock market. And so it's interesting. Canadian people overweight Canadian stocks and U.S. people overweight U.S. stocks. So I'm just going to focus on the U.S. stocks right now. But in the first quarter, we saw a significant rally in growth. Okay. Going back in time a little bit, the last year and a half, well, let's go back 10 years. Okay. So the last 5 to 10 years has been growth, tech, and the value and small cap and international emerging markets all underperformed growth. And so, but over the last year and a half or so, value has kicked the pants off of growth. So we had a reversion, or like a reversal to value. First quarter, boom, it's back to growth. And especially large cap growth here, you can see was up 14%. Small cap growth was up 6%, where your value is trailing. Okay. So just something to make note of. And I think what that could be attributed to is, people expecting an end to the interest rate hikes, and because growth companies are especially sensitive to higher interest rates. That's just conjecture, but that could be what's happening. But here's a little video that we thought was cool. Okay. But it kind of shows, even within that growth component, it was still skewed towards 8 companies. And these are they call them the, what do they call them?
They call them the FANG plus MNT for Microsoft,
okay,
NVIDIA, and Tesla.
So this is kind of a little quick video illustration of what happened. And as you can see in the top left, this is January each day. So you can see the sheer size of Apple, Microsoft, Amazon. We've talked about this at length in the past, about the concentration of these big, huge, giant companies within the S&P 500, which is kind of record breaking. So basically what happened was the S&P 500 was up somewhere around 7% or so in the first quarter, but these 8 companies comprise 5.5% of the entire index's return. So 5.5% of the 7% was from these 8 companies. And again, it's Apple, NVIDIA, Microsoft, Tesla, Meta, Amazon, Google, and the typical names. And so
and you can see the influence of just technology alone, with it driving the return of the S&P 500.
Exactly.
So it's not
And
like
then,
it's not like it's a broad recovery. It's still kind of concentrated.
correct. And in the first, actually in the month of April, that's even changed a little bit, where you've seen healthcare stocks and some of these other stocks that were trailing have actually outperformed. So this is an ebb and flow of things. But one thing we have to keep in mind is that even in this growth-centric world that we've been in the last 10 years, if we look at the statistics, and hopefully you can see this, is value beats growth over any 1 year trailing period of time, 60% of the time. Value beats growth over every 5 year trailing period, 70% of the time. And over 10 years, it's almost 80%. And in addition, small, it's been a large cap growth thing. Even small has the same characteristics. Okay. So, and this is going back to, 1926. So this isn't a small subset. So with the higher interest rates environment, growth stocks, might be challenged. And so we'll just have to watch that trend and see what happens. Okay. So
You may have heard.
yeah, you may have heard. So one thing that we did ask is to send us questions about what's on your mind, and we've also had the advisors of questions that were being asked, and one was certainly the banking crisis, because that's the most recent event. And yes, it probably has changed things, and this is kind of a funny cartoon there, but the banking crisis, everybody's heard about this at this point: Silicon Valley Bank, Signature Bank, and then our newest entrant as of this week, First Republic, which their stock's gone from like $200 to $5. I haven't seen it today. It might be zero today. And they may be claiming bankruptcy by the end of the week. Who knows? But what is important is these are big banks. These are big regional banks, and so they will certainly have an impact, on the banking industry and the lending industry and the economy. We just have to wait and see how that plays out. But let's start with one thing that the real question is,
how did it all happen?
How did it happen? Okay,
Yeah.
so this is, again, I've shown this chart before. This is the series of rate hikes that we've seen. So starting in, what was that, January? I don't know what that is, February, March of last year.
Right.
Basically, rates went from 0 all the way up to 5%. And then the market, they were saying as of last week, there was an 80% chance that they were going to raise again next week, quarter point. So common sense tells us that has to have some influence on the economy. Okay. But how did this, okay. So with that in context, how did this happen? Okay. What were these banks thinking? And so I think you kind of have to look at the so-called yield curve that you've probably heard of, and we've talked about in the past. And this shows you a yield curve from December 31st, 2021. Now, this one is a natural, normal yield curve, okay? Upward sloping. And the reason that is, this is what it should look like. And the reason being is, if you're going to buy a 30-year treasury and give the government your money for 30 years, they better pay you more interest than if you're giving it to them for 30 seconds or 30 days, okay? So, but as you can see in the low interest rate environment, interest rates were like basically 0. 30 years were still a pittance, but at least it was earning something. Okay. And so basically what happened is the Federal Reserve was just pushing all this liquidity into the banks. And these banks were saying, we can't earn we can't earn anything on 30, 60, 90-day treasuries. So they started extending their duration, their maturities. And so they went longer on this yield curve. And they probably didn't go 30 years, but they were probably playing in the belly right here of the steepest part of this yield curve right here. And so basically, yeah, go ahead, Deb.
Oh, I was just going to say, so the idea here was the banks are investing longer term because they're going to get 2% return on their money, and they're going to pay the depositors, what was the interest
Zero.
rate, your checking
They're going
account
to pay.
zero
They're going to
or
pay checking deposit
0.1?
or 0.1.
So they're pocketing that profit in their pockets by doing that.
Yeah, and that's the way banks make money. They make it on the spread. Is what do they pay depositors? They take the money that that depositors put in their accounts, and then they lend it out and earn interest on the loans, less any defaults that happen in that portfolio. It's pretty simple business, other than the underwriting is complicated, obviously. So flash forward to 2022. This is what an inverted yield curve looks like. This is a not natural event. Okay. And typically you may have heard this happens preceding recessions. And basically when Powell, if we go back and when Powell was increasing interest rates, the Federal Reserve increases the short-term interest rates. Okay. Which is basically here. Okay. And so, so basically what happened was, and this is where it kind of, the perfect storm hit these regional banks and some of the other banks, is all of a sudden when the Federal Reserve is raising short-term interest rates, money market accounts start going up commensurate. So if you raise interest rates from 0 to 5%, money markets are going to go up from 0 to maybe 4.5%.
Right.
And so the banks are now paying depositors more money. And then when you had the run on the bank, the banks didn't have enough money, so they had to sell these short-term or these longer-term investments, which were all at a loss. And again, this gets complicated, but bonds, as interest rates go up, the value of the bonds goes down. And am I explaining that right? Then
I was going to point out, like, look at that 20-year bond on the bottom curve. It's 1.9, and so that same bond now is yielding 3.8. And basically that results in the price of that bond going down. So when the banks have to raise money to either pay depositors a higher interest rate or satisfy withdrawals, they got to sell those at a loss. And that's kind of what started the whole demise of Silicon Valley.
So they probably realistically had a 10% loss, maybe a 15% loss in these longer term holdings that they were forced to liquidate. And that's when things really turn bad, is when you're illiquid, then you have a run on the bank, and then you have no money to give them, and you have to sell securities at losses. Yeah. And that's basically what happened.
Yeah. They didn't even get to the point where they started to sell those securities. They announced that they were going to sell securities, and then all of a sudden that triggered people to pick up their phone and move their money out. Started to run the bank.
And Dan, that's a really good point, because I heard someone talking about this the other day, and it just kind of hit me like right between the eyes. Is basically they were talking about the big banks, the big mega banks that we all know about. They encouraged us over the last 5 to 10 years to do business on our phones. Well, one, to first do it online, and then to do it on our phones, like to make deposits from our phones, take a picture, deposit it. And while they were closing branches, they think they were becoming more profitable because they have less people, they have less overhead, less branches. But what they didn't realize is once you've appified, like using iPhone apps to move your money back and forth, once you've done that, it's extremely easy for people to move their money, to have a run on the bank. You don't have to go into the bank. You don't have to wait for a teller. You just get on your phone and move it. And
if you compare that in contrast to the last big bank run period of like the Great Depression, first of all, there was no Twitter, there was no social media to spread the word. So it was word of mouth. Now that can spread pretty fast itself. But if you wanted to go get your money out of the bank, you had to, put your coat on, put your fedora on, go, leave your house, go to the bank itself, wait in line to do that. You may have to take a day off of work or something. So there was like a natural, you had to kind of swim against tide to get your money out, do a certain effort. But now, the banking situation has totally changed. Like you said, it's technology driven. We can do it from our phone, and we don't have to get out of our pajamas to withdraw our money.
Yep. And so, over the last year and a half or so, our clients, who are watching have seen us buying what we call traded mutual funds. And basically the bank's business model is to pay depositors zero and to make money on lending. Okay. But, so basically what we've been doing is moving money out of zero and moving it into higher yielding things, money markets paying 4.5%. We're buying treasuries as rates went up. So we think we were pretty far ahead of this, but now it's really in the news and everybody is chasing yield. And that's creating challenges for the banks. And one of the things about this Silicon Valley and all the other banks is what's going to happen, or what is happening, is these regional banks could very well get gobbled up by these mega banks. So you could have 4 banks at the end of this and no regional banks, or very few regional banks. Right. The problem with that is most small businesses, say those with under 500 employees, they all use regional banks. Right. Because they will do underwriting and they will lend to a business that's growing, whereas some of the bigger banks will say, hey, you don't fit in my box. The answer is no. And so there's very little underwriting going on. So there will certainly be an impact on this. And as these credit conditions tighten, and when I mean credit conditions, the banks are not doing as many loans as they may have in the past, that is definitely, I don't know if it's the word is recessionary, but it's definitely going to impact growth in the economy.
Hey, just real quickly, we have a question with regard to this. So I'll just bring it up now. So, the question basically is, if we have money at First Republic, do we recommend getting it out of there? It says here they're below the FDIC limit. So should they remove their money, or is the money at risk? I guess the short answer is no, your money's not at risk. But if the bank, if I guess First Republic does come under FDIC control, you might have a period of time where you can't get to that money. So if you have other liquidity or other bank accounts elsewhere, cash you can get to, it's probably okay to leave it with First Republic. Republic, yeah, that's right. If you're over the FDIC limits, I suggest kind of getting under those limits. Probably, those limits, get underneath, not by a few bucks, by quite a few dollars, and just make sure you're under those limits so you're protected. And just understand that if it does get taken over, there might be a short period of time where you may not be able to interact with that account. And I don't know what the lag time might be. It could be a week, maybe a month or something like that. I'm not really sure. But maybe I can look into that and find that answer.
Yeah. I agree with that. If you're at one of these big 4 mega banks, or the Wells Fargo, B of A type banks, you probably have less to worry about, because now, unfortunately, in this status that we are in, the too big to fail banks will not be allowed to fail by the government, and they keep bailing them out. So even if you're above that, we still always suggest you stay under the FDIC limits, but it's probably a bigger issue with some of the regional banks. It's a great question. Okay, so moving on. Daniel,
this is me. I'm sorry, I was writing a note. Sorry. So the other thing is kind of hitting the news, and it's going to be in the news more and more and more as we kind of march forward, is this debt ceiling debate we're having. So this comes up, I don't know, every 8 to 10 years or something like that. I think the last time this came up was in 2011 when Obama was in office. So just for a little bit of background, we actually hit the debt ceiling in January, but the Treasury and the Fed have things that they can do to kind of stretch out that period where they can continue to pay the bills until Congress until Congress takes action. So Congress has to raise that debt ceiling so that the the government can still continue to pay its bills, pay its employees, keep the lights on, et cetera, et cetera, et cetera, pay the debt. So the last time in 2011, I think it was, when this really kind of came to a head, and basically becomes a political game where, in this case, the Republicans are going to try and get concessions on the budget, on spending, in order to kind of raise the debt ceiling. But the last time this happened in 2011, they kind of passed that point of no return, and U.S. debt was actually downgraded by the S&P, Standard & Poor's rating company. So that kind of had a shockwave effect through the bond market at that time. Will that happen again? Maybe. I think they'll probably take it down to the wire. They usually do, but they'll end up raising the debt ceiling. It's inconceivable that they would not do that for indefinite period of time. This is a political, like the cartoon says, this is a political tactic to kind of get what one party wants over the other and use it as leverage.
And basically what you'll start hearing in the news here soon is they're going to cut Social Security. They're going to have to cut all this stuff. And as that deadline approaches and it becomes more and more political, my recollection, Dan, in 2011 was S&P downgraded the U.S. debt, but nothing really happened to our bond market because people didn't believe that it was really because we were still the strongest, country in the world. Things have changed. We have so much more debt now than we did in 2011 that who knows what might happen. And then we also have this reserve currency business. So
you're probably right, because I can't remember anything, before April 11th, let alone 2011. So
Yep. Okay, so
let's go to the next thing.
Speaking of reserve currency.
Yeah. So this was another question that's kind of, we've heard from clients over the last, 3 or 4 months about the reserve status of the US dollar. Basically, the US dollar is used throughout the international trade to price items, oil, gold, a lot of commodities. And that's how trade is done and completed. It's talked about in US dollars. And even if you don't have US dollars and you agree to a price, you exchange for US dollars and complete the trade. So go to the next slide real quick. So this is kind of how it kind of began. Saudi Arabia is talking about increasing solidifying their relationships with China, which leads to talk about maybe pricing oil in the Chinese yuan, or maybe some other currency. It kind of helps them to those countries to have more influence, have a little more power, a little more sway in things. So, this is going to affect Iran, China, Russia, Saudi Arabia, Venezuela. These are the countries that are kind of looking to debase the U.S. currency. And it seems like it's happening fast, but, I think this is a long-term issue. It's not going to happen overnight. Yes, the U.S. will not always be the reserve currency. Empires fade over time. And if you saw the change in the reserve currency over the last 100 years, you might be surprised how it has changed. I looked at that the other day and I was kind of surprised. But anyways, so this chart here kind of shows you basically the U.S. dollar is the reserve currency for 60% of the world. So we still have a lot of influence, a lot of sway. It's been going down over the last 8 years. But in order for another currency to be used as a reserve currency, and not just in a little, I don't want to call it a niche, but not just in like a little part of the world, but to have it be used throughout the world, throughout various countries, economies, and whatnot. There's certain things that they have to get there, and these are all things that the U.S. has demonstrated over 100 years, where the U.S. dollar has been used more of a reserve currency. So, one of those things is we have a lot of transparency in our finances. So there's no like a hidden ledger, so to speak. So the information is free. That's a hurdle you have to kind of get over. We also have the rule of law. So even if you are wrong, you have recourse through courts to get your money back. So that's another important factor. And you have to
also, Dan, the United States doesn't throw Jack Ma, the Amazon equivalent of Jeff Bezos, in prison where he doesn't go missing for 3 months.
Right.
So there's other issues with China.
Yeah, and so it basically those two factors kind of build trust in the issuing company, which is the last kind of thing that you have to be a reserve currency. So if you just imagine that, what other countries in the world have that? There's probably very few. I don't think China is one of them. I don't think Russia is one of them. Because those countries can seize accounts, seize your assets, kick you out. And kind of leave you with your pockets hanging out of your pants, so to speak. So that issue is kind of a longer term thing. There's got to be, if China is going to be the reserve currency, they got to have greater transparency. You got to have some recourse through the courts to air your grievances or have your grievances resolved, that kind of thing. And I don't think they're even anywhere near that, where, especially like you said, they're throwing people in jail just because they need to quiet them down. And they're an influential trade partner, but as a reserve currency, I just don't think they're not there yet. So,
well, one thing just to add, Dan, is this chart right here is just through the end of 2022.
Yeah,
that is, if I couldn't find a current chart, but that percentage share of reserve currency has dropped, pretty dramatically in the last 3 months as a result of these new current events. And I don't want to discount the importance of this, because those countries that Dan mentioned before, Iran and Saudi Arabia and blah, 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 they can go ahead and price things in different currencies. Okay. But and so the share, the US dollar share of that reserve currency can be impacted. And so this is one of the questions I've been getting most from clients, is the reserve currency is what's the impact and how can I take advantage of it, right? And so just to add, I think the impact of this, if it keeps accelerating, is one of the reasons that the US has been able to just print, hit a keystroke on the computer and make money out of thin air, is because we had such a strong high percentage of the reserve currency. If that's not the case, then debt, the amount of debt starts to matter, and it starts to matter significantly. I still think it's a longer term thing. And then, the more established markets, let's face it, China, just like you were saying, they throw people in jail. Nobody has believed a GDP report out of China in 20 years. They fudged all the numbers.
Yeah.
And so I do think it's probably more overblown, but I don't want to, I don't want to discount it. So back to, well, how do you invest? This is so new. I've told people, I have no idea. I mean, I guess you could buy gold, maybe you short the dollar, but if it is a long-term 10, 15, 20-year trend, you're going to be on the wrong side of that.
Yeah.
And so I think you just kind of have to wait, play it out, diversify your investments is the proper way to do it.
Yeah. Right. So here comes the ongoing talk about inflation. I think we're all feeling it, especially when it comes to, eating out or buying food. That's where I see it the most. It's the bill at a restaurant is just insane, and eating longer just for 2 people without drinks. It's kind of crazy. But anyways, that's a great slide there. So the fight on inflation goes on. You showed the slide earlier where the Powell has increased interest rates, 12, 14 times in the last year. They're probably going to continue to increase in interest rates. So they're really committed to fighting inflation, to resolving it. That fight goes on, and I expect that they'll increase interest rates yet again next month. I think people probably hoping that they'll pivot. I don't think they will. Go to the next slide just for real quick. So this is kind of a longer term view of things. So the reason why we have inflation, and this has kind of been a longer term action going on, but it really kind of came to a head in the last couple of years, is that there's been a lot of money creation. They pushed, Feds pushed a lot of liquidity into the market. And it really, and then you can see here in this chart how much debt's increased in each year, but look at 2020.
19%,
2020, and just skyrocketed. So there was a giant influx of liquidity into the market. It's kind of sat in bank accounts for a while, and pretty soon it started getting spent. But then you layer in supply chain issues, and that was the cause of the inflation that we've been experiencing, particularly in 2022. And this is a longer term issue with the debt overhang that I think we'll address a little later. But let's go to the next slide. So has the Fed's actions been effective? Yes, this is a heat map of inflation over the last 3 years. And so anything in the kind of the orange, red, and yellow, those are high inflationary sectors, areas of spending. And as you can see in 2022 is really red and yellow there. But as we've gotten to 2023, we're seeing more of the softer yellows and the greens appearing more often. So the Fed's efforts have been effective in some areas, obviously in areas of shelter or basically rents, home prices. It really hasn't been that effective, but I'm sure as we go forward, we'll start to see those areas cool more. But go to the next slide and we'll kind of see the real, a more concise effect of this. So this has been inflation over since last June, where we started at 9% inflation, and looking at March, we're down to about 5%. So the push to increase interest rates has been effective in slowing down inflation, and it probably continue to have ripple effect going forward, even if they stopped or pivoted, or not pivoted, but if they paused, you'd probably still see inflation reduce going forward, but I don't think they're going to pause. So I talked a little bit about how we got there with the liquidity happening not just in 2020, but going back to like even the Great Recession. So that's kind of when it really started. But go to the next slide. So this has been their activity going forward. So they've been really kind of cranking out the printing money, so to speak. And we call this printing money. They're not literally printing money, but they're electronically or digitally creating liquidity. And as I said, so all this printing has led to like a debt overhang. But all of this effort that the Fed's been doing over the course of the last year or so has kind of led to them saying, and they even come out and saying, they've started using the R word last year, the R word being recession. And they're really trying to create a recession in order to kind of tamp down inflation, reset things so that we can kind of enter a more normal business cycle, I guess you might say, and have an area where inflation's under control, and we can kind of start reducing interest rates. So if you go to the next slide.
Yeah. So just to interject, I think you misspoke on one thing. The Fed never talks about recession, ever.
Yeah.
It's soft landing. Hey, we're on a glide path to a soft landing. But we've also mentioned over the last year and a half in these webinars that Fed's never had a soft landing. Every recession is created, I shouldn't say every, most recessions are created by the Fed and their inactions or their wrong actions, okay? But one thing happened, I think it was last week, is, as Dan mentioned, they finally in their Fed notes, they said that there might be a mild recession. They would never say a recession. It's of course the soft landing. It's got to be a mild recession starting later this year. And this is, the Fed never says that. Okay, but they did. So they very well could be preparing us for something, who knows, more than a mild recession. But but who knows? The one thing is for sure, I shouldn't say for sure, is the Federal Reserve can't control inflation except there's only one way to control it. They can't control the supply chains, but they can control demand. And control demand, meaning spending in this case by consumers. How do you control it? Well, you wreck them financially, right? You increase their interest rates, you cause a recession where people start losing jobs, and that's how you kill demand, even though they won't say it. And so how do you do that? Well, you jack interest rates up, like we said, right? And so anyway, I would expect that that over the months to come, we're going to start seeing some, and this with the bank stuff as well, we're going to start hearing some pretty bad numbers, bad stuff. There's no doubt that things are slowing now. Debt is going up, credit card balances are going up, auto loans are delinquencies are going up both on credit cards and auto loans. Corporations who had lines of credit that they were paying 4% are now paying 9%. And for those that use these line of credits to finance their growth and normal operations, that's significant. And so we have to keep that in mind. Dan, you want to talk to, this is kind of the forecast currently.
Yeah, I mentioned earlier there that I think they're going to increase interest rates, but this basically illustrates what the Fed's intentions are. So if the dark black line is what the Fed has done with the interest rates, and so you can see they've since 2022 they've increased. That's funny. Just notice I'm using my cursor on my computer to kind of to draw the eye
black line
about,
here,
but
you
no
go.
one
There
else
you go,
can
black
see
line.
it.
Yep.
So it is, yeah, right there. So this is where they're at. The little blue extension, the dot in the blue square there at 5.10. This is what the Fed's telegraph where they want to go. So they're hoping to peak out at 5.1 probably sometime this year, and at which point they think they'll be at a point where they can kind of start reducing interest rates. So that's their intention, is to continue with it. Now, could they change their mind? Could they pause? They might, but that would probably depend on what the current economic situation is, whether they're having continued bank failures might be a factor in their decision. But right now, from their statements, this is their intention to go forward.
Well, and just to add one thing, so basically you can see they're expecting to be around 3% by in 2025, and
Right.
for them to be lowering interest rates like this, they don't just lower interest rates if the economy is doing great. They keep interest rates where they're at, right? They lower interest rates if they need to spur economic growth or to stop layoffs, companies from laying off. So this is what is so interesting. They've talked about the Fed pivot. Every time the people thought the Fed was going to stop raising interest rates, stock market went up. And so, but in the past, a lot of these so-called bear markets, when the first rate decrease happens, the market goes down. It doesn't go up because people go, "Oh, crap! It's bad." Okay, so anyway, enough about that. So, okay, is this me or you, Dan, talking about this? Let's see here.
I'll swing at this.
Okay.
So, I think this is still you, but hey, I'll talk about it. So,
okay,
going forward, kind of looking ahead, what do we see as happening with the markets or the economy? So we talked a little bit about the debt overhang a little bit earlier. All this stimulus meant the government borrowed more to kind of create liquidity in the market. So there's an incredible amount of debt in the market. This is a long-term issue that's either it's got to be addressed in some way. I guess if you're a politician or a consultant to the politicians. They really want to grow out of this problem. That is, grow the economy to where the debt level where it is kind of looks smaller because your economy's grown. But too much debt at a certain point starts to have a negative effect.
Yeah,
debt can have a very positive effect in leveraging and growing your economy. But at a certain point, it becomes a drag because
until you get as much debt as we have.
Yes, yeah.
There's a point of no return where you can't grow because of the debt overhang, and many people think that's where we're at. So that's going to be a challenge. I'll just talk about this. I guess the tightening credit, we said is kind of, is what happens when there are recessions or slow growth is the banks tighten. They get afraid to do loans because they think their consumers, the ones who are the lenders, the borrowers, won't be able to pay. So they kind of get really conservative. And then what that happens is that constrains the economic growth as well. And we talked about, the difference between 4% and 9%, or difference between a 2.75% 30-year fix for a homeowner and a 6%.
Or even if there's a consolidation in the banking market to where you get, the four gigantic banks with a great deal of influence, they might not lend to the smaller borrowers that a regional bank would normally work with.
Mm-hmm.
That's also a tightening.
Yep. Jobs market. Sorry to kind of end down. Jobs market is been incredibly strong, and that's what everybody's saying. This time's different. They always say this time's different. This time's different because the job market is so strong. And but basically, if you dissect the data, the service industries are the ones that are still strong. Hospitality, entertainment, the ones that were still clawing out of COVID. Where if you dig deeper, there have been some job cuts. So basically, if we do start seeing slower and slower growth, you will start seeing the unemployment rate go up.
Yeah.
And
right now, the layoffs you've heard about in the news have been like at management level, top level stuff. We haven't really kind of seen it filter down to the blue collar people.
Exactly. Okay, let's kind of move this on, Dan. We're getting a little long.
We're almost. I just noticed we're almost at an hour.
Yeah.
So obviously, I think real briefly, real estate's kind of got some headwinds there. Nobody's going to. The housing market's slowing down. Nobody's refining. Real estate prices are really high, so it's hard for new buyers to come in. People like Mark and I, or the people listening, having refinanced your mortgage to once in a lifetime lows of probably under 3% for a home loan. You're not gonna sell that. You're not motivated to sell your home now just to buy a place and have a loan at a higher interest rate. So there's some issues there. But the other bigger issue is commercial and office space. We're starting to see greater vacancies there, and the effect of COVID, work from home kind of approaches have probably kind of changed the landscape of what going to work means. And so either something has to change where companies got to either demand people to come into work to fill up this office space, or it's got to be repurposed in some fashion. But right now, it looks like we're going to have a period of time where there's going to be more vacancies, at least on the commercial and office side, which could be a drag, at least in the real estate area.
Yeah, and I read a stat the other day that the 50 top metro areas, the vacancy rate of commercial or like office is 19%.
Yeah.
Where pre-COVID it was 7%. So just to give you an idea of the magnitude. We're talking about a lot of negative stuff. So we can move forward about some. It's not. We don't want you to like jump out a window. So just secure the windows and lock the door.
A lot of fear things. So, but don't be fearful.
Yeah. So let's see here. Let me see. Okay. So let me just kind of bring this back to kind of financial markets. This is just a quick chart. This is where we were at the low when we were down 25%. So we've seen a rally. I won't belabor that because we're short on time. One of the things I showed you last time, if you tuned in, is one of the lead analysts at Fidelity analyzed all these different bear markets, and they concluded that the 1946 to 48 market was most similar to this market. You have other people on TV saying it's just like the dot-com bubble, but there's differences. So one question that we have that's still not is still not resolved is, did we see the lows in October, or are we in a series of sideways? The black is our market versus the 46. Are we going to see a series of zigs and zags in a sideways market? What would cause this, in my opinion, is because analysts have projected earnings incorrectly. And so let's just say the economy falls more than expected and the analysts get the earnings forecast wrong. The stock market is like a weighing machine. It's always weighing information. And so as this bad information comes out, and I think it is going to be coming, the market could very well zig and zag. Okay. So just keep in mind, I've heard the bears on TV, they're saying the S&P could go down from 4,000 to 3,000 or 3,200 and stuff like that. And it's possible. It is possible. But if that does happen, I think you have to take advantage of it. So another thing real quick, I'm going to start kind of rushing through these real quick, is, this is a slide of we had an inverted yield curve. And then what happens is the curve starts steepening, which has been happening over the last month. And then the Fed will cut rates. But basically, you can see that earnings usually don't trough or bottom for, another 6, 9, 12 months. Okay.
Yeah.
But importantly, just as important, this is where kind of, stay in the boat kind of thing, is I showed this slide last time, which is stocks are, again, forward looking, 6, 9, 12 months. The information right now, where it's trading right now, is where they think earnings are going to be in a year or whatever. And so this chart showed that earnings right here usually hit their bottom 6 months or so after the stock market's hit its bottom. Okay.
The stock market's represented by that blue line. You can see where the trough is right there, where the axis comes together. So
it's entirely possible. We've got all this bad news coming out and the market goes down another 10% or 15%, but that could be it. That could be the bottom, even though a whole bunch of bad information is coming out and the doomsday news reports. In fact, that's a good segue for this. Dan, you want to talk about that?
Yeah. So I guess in all of this, we've talked a lot about fearful things, oncoming recession, but like Mark just said, the market's forward looking. So the market could be recovering long before we even kind of get into the recession, into the depths of a recession, I should say. So, but I guess what we want to tell you is, don't believe the hype that you might be seeing on the television shows. So one of these things that CNBC does regularly, semi-regularly, is, they'll have the markets in turmoil special report. And so they'll cut out an hour to talk about how terrible the stock market is. But what actually happens during the moment of turmoil, what happens next isn't probably what you would expect. So go to the next slide.
We've made fun of the media that it's probably, if you do the exact opposite of what they say,
right,
you're probably in good shape. But and this kind of shows that.
This is a good indication to be a contrarian. So this is a list of specials, the markets in turmoil broadcasts that they've had, and the date they've had them, and what the 1 year forward return of the stock market has been after each broadcast. So like
starting in 2010.
Yeah.
Look at those 1 year returns. And I don't see any red here. It looks like they're all up. So
that's this kind of feeds into the idea that markets are forward looking, though, even though we're in the midst of something in the moment it's happening, doesn't necessarily mean that's going to be what's going to go on going forward. So
okay, let's move in.
Don't believe the hype. Yeah. Go for it. So
well, you can believe the economic hype, but don't believe it correlates to investments. directly.
So let's talk about a little bit what we've been doing, how we've kind of positioning, how we're changing our positioning a little bit here in the markets. So I think we've used this chart before to illustrate kind of value within the market. And I think the area to kind of focus in on is that lower right section there. So we've had, like Mark said earlier, growth has kind of taken we had a reversal to value, taken prominence in the last year and a half, but this year growth has caught up. So those top numbers look like their growth is probably a little bit overvalued, where in the small cap and particularly the small growth area in that lower right corner there, we're finding a lot of value in those areas, in that area of the market. So we've taken a kind of a look at the underlying, what we would call an X-ray look at our portfolio that we're using for clients, and seeing how our exposure to those small cap, small growth are. And we've made some slight adjustments that kind of increase our tilts into those areas to kind of take advantage of what we're seeing as where more value lies in the stock market. It's a very subtle kind of thing. It's not a chips all in kind of thing. We're never going to do that. But we do want to kind of tilt a little bit just to kind of take advantage of when those markets rebound, and they will. Mark, you want to add anything?
Yeah, a couple other things we've been doing. Since real estate has gone down a lot, we've been increasing our exposure to real estate, even though it might not make sense. But again, markets, a lot of the damage is probably already priced in. So we're positioning for future returns. Some of our hedges have worked out great. Yes. Inflation hedges, we're starting to take those off. We're adding, our gold position is up 20% since, I don't know, October, November. So that's been working well. We're looking to add some other alternatives. And just to also talk about, again, given most people have already faced their tax time, or maybe they're on extension or waiting, just to remind people, all the tax loss harvesting that we did last year, all those losses that we actively and intentionally raised will be, can be effectively used for reducing capital gains, and those can be carried forward indefinitely. And so I think those are all some positive things. So, okay, so let's bring this home.
But the overall thing is, don't get mired in the right now. Keep a longer term view. We've talked about this earlier. Go to the next slide, Mark, real quickly. So here's the real long-term view. And if it's a little fuzzy, I'm sorry, but this is basically saying all those boxes in blue are up markets, and all the boxes in red are down years. So we obviously see we've had way more positive years than we've had negative return years.
75%
stock market, 75%,
25%
up versus 25 down.
And this chart also, just to, what's interesting is you see the most returns are in the 20 to 30%. Very, not very often are they 0 to 10 or the average. So, so it's just kind of more a visual, interesting thing. Here's another visual that I think is even more impactful.
This is kind of a different view of the previous slide, is that the blue are up markets, the red is negative markets, but this is just to illustrate that even though we have negative markets, they're generally short-lived. So it's just a matter of, and I think this last year has been last year with a longer down market than we have experienced in quite a while, where we didn't have like a pretty significant rebound coming out of it, and it kind of tests our patience, it tests our resolve. And one of the key things to being a successful investor is to be patient. Sometimes the market can be irrational longer than you expect. So it's a matter of just kind of approaching with a plan in place, have a long-term view, and don't make sudden decisions or changes based on the hype. Based on the markets in turmoil.
Yeah, in this particular market, since we're already 15, 16 months into it, is a longer one. And especially if it extends, I mean, a 2-year bear market was like the 70s. Okay, I mean, we don't want to discount the severity of this, but again, if that was a 2-year horrible bear market, so just to keep it in context, that this shall too pass. or whatever the saying is. And so, so again, try not to get too negative based or headline driven, because markets could turn around very quickly. We might have some volatility, and I would expect some volatility in the months to come, but followed by the next bull market, which could be, who knows, how long and the upward trajectory that could be. So
that was it. We don't have any other questions in the chat boxes here, Mark. So
okay,
well done.
Yeah. So if you have questions,
longer than I thought, but
yeah, if you have questions, we're 1 minute over. We thought this was going to be like 40 minutes. Our apologies. Hopefully it was reasonably good information. But if you have any questions, feel free to reach out to your advisor. You can call our office. You can email to rscrum@rscrum.com, and everybody sees the message. And again, we want to thank you for attending. And for those who didn't attend, we want to thank those who are watching on the replay. So with that said,
and don't forget the client survey coming out next week. Please take, if you have a moment, please participate. We appreciate your responses to those.
Okay.
Thanks.
Thank you. All right. Have a good day.
See ya.